Aaron, in our last conversation, you told me I can borrow against my gold. But can you give me a little bit more detail of how that works?
Yeah, I'd love to talk about transacting in gold on margin and borrowing against your physical bullion because it's a topic that we've received a lot of interest in. So I'd like to clarify how this works. So our allocated gold bullion program generally involves owning specific bars that are housed at the mint. Borrowing against them falls into the regular margin environment. So just like you'd set up a margin account and borrow against your stocks and bonds, you could set up a margin account that owns your gold bullion and then borrow against your bullion. And the amount you can borrow is determined based on sort of the standardized borrowing rates that apply to margin accounts. And currently in January of 2026, that margin sort of loan to value is 75%. So if you own $1 million of gold, the maximum you can borrow against it is $750,000, subject to all the usual constraints and specific details related to margin suitability.
I have some gold myself. Can I bring it to you and borrow against it?
So unfortunately, our program does not accept delivery of bullion from outside the institution, at least not physical bullion. If you had a gold certificate, it's possible to bring in a certificate from another institution and deposit in your account. There is no real difference between borrowing against physical bullion that sits at the mint and borrowing against a gold certificate. So that's not an element you need to be concerned about. But what we won't do is if you have bars in your vault in your house, you can't bring them to us and then borrow against it. That's not a transaction that we can facilitate in our program.
And if I decided to go ahead and borrow against the gold, what risk am I assuming?
So the risks associated with trading on margin are quite complex, but basically, as soon as you introduce leverage into an investment portfolio, whether it's gold or stocks and bonds or whatever else, all of a sudden the path of the price matters. So it may be that generally speaking, the price of bullion has moved from the bottom left of the chart to the upper right of the chart. And it generally charges forward with inflation or whatever other factors determine the price of gold. But it can also move down. And there's been long periods of time when gold bullion has lost huge amounts of price value. It's unfortunate when somebody has the right direction but the wrong timing in an investment. So if you bought bullion and borrowed against it to facilitate maybe other investments, then the path of the price matters. And if the next day bullion starts to decline, well, you'd either have to come up with more capital, more margin, or you would have to sell your bullion to cover the difference, basically, in how the price has moved. So it's important to remember that whenever you introduce margin or borrowing into an investment portfolio, now you have this additional layer of complexity that you need to think about.
And can you tell me about this investment strategy a little bit more and how does it work?
So there's a variety of investment strategies you can employ when you start introducing margin. One common one that we've been seeing or facilitating is purchasing bullion and then borrowing against it to sort of fund a investment account that owns stocks and bonds. And it's not a binary thing where you have to do one or the other, but some clients that we've spoken to like to buy bullion, then borrow against it, and facilitate a broader investment portfolio. It's important that you do that in the right order, not the other way around, and we'll talk about that in a moment. But that is a strategy that we've been seeing, and it can be facilitated with the understanding that you have to be sophisticated enough to understand the risk, and you have to have enough liquidity and capital to support any sort of variation. But that's technically possible to do.
And are there any tax implications for these investment strategies?
Yeah, so a really interesting tax implication of borrowing against gold is that sometimes what we've seen is clients who will borrow against their investment portfolio to purchase bullion. The problem with that is one of the requirements to make a margin loan, the interest on a margin loan, tax deductible, is you have to be investing in securities that might generate an income. And bullion is unique in its characteristic in that it will not generate an income. If you buy a gold bar and you wait 100 years, you're still going to have a gold bar and it will not have spun off any income in that time, even though the value may have gone up. Whereas stocks and bonds, that's not the case. So if you're going to execute that type of strategy, it's important that you do it in the right order, where you use your cash to create the bullion position and then borrow against the bullion to own the investment portfolio, in which case, subject it to the advice you would get from your tax accountant and the advice you would get from your investment advisor. It is possible to execute that type of strategy where the interest on the margin loan is tax deductible, or most likely would be tax deductible. So that's a really important consideration that is often sort of overlooked.
And are there any other considerations I need to be made aware of before I execute this strategy?
So the most important thing when you're dealing with margin is to understand the risk. Understanding the risk requires that you're working with somebody who can educate you as to the risks, and that you have enough liquidity that you can cover the volatility in the market. This is not something you should engage in with your last dollar. It's not something you should engage in for your retirement portfolio. It's a sophisticated, complicated wealth management strategy that's only appropriate for certain types of investors and certain types of circumstances. And it's important that you're getting good quality advice on how it's structured and good quality advice in terms of what risks you're subjecting yourself to by facilitating or engaging in such a strategy.